This is for educational purposes. There's nothing being solicited. I am a investment advisory representative with Financial Network Investment Corporation, and securities and investment advisory services are offered through Financial Network Investment Corporation. I brought my whiteboard. I want to show you something that will help you understand what you do with this. So if you can measure risk, we measure it in what's called standard deviation. Standard deviation is a percentage, and it sort of represents in a given year what is the high probability of outcome for the next year. What's the range? So if I put down here, if I call this part of the graph standard deviation, and let's just say that this is something like 20 and 18 and 10 and 5 and 2. Basically, the further I move out here, if I pick something that's over here with a 20 standard deviation of 20, then what I'm saying is in any given year, my expectation is that the price of that asset is going to be up 20% or down 20% from the previous year. So if I got a standard deviation of 50, then I'm expecting it's either going to go up like a rocket or it's going to drop like a bomb, okay? And so that's standard deviation. And then on this side, you have return, right? So that's risk. That's how we measure it. And on this side, we have return. And let's just call this 2%, 4%, 6%, 8, 10, 12, so on and so forth. Okay, when you think about the traditional relationship between stocks and bonds and this whole asset allocation, where does it come from? What we were able to see is that if you were to buy a portfolio of 100% U.S. government bonds and hold it for the last 25, 30 years, that you would find a typical standard deviation somewhere down here, say around 6%, and your average return is probably going to be around 4. Like this is where you would plot that point for 100% bonds. And I'm sorry if you can't see this in the back, but at least you kind of get the picture. So you would have a typical standard deviation of 6, and your return might be 4. Now, on the flip side, if you're aggressive, you say, I want to put 100% of my money in stocks, and I understand in doing that I'm going to get a lot of volatility, but I'm going to go because I want more return. And you would go back over the last 30 years and you say, well, if I was going to do that over the last 30 years, my 30-year average might be somewhere around 11, but my standard deviation is going to be up here. So this might represent 100% stocks. And then when you think about, well, what if I were to blend some of these together, right? And you guys have probably seen this if you've done economics class before, but for those of you who haven't, this is what this ends up doing. You end up getting a curve that looks like that. And what this curve represents is, if I were to use something like this point, this would represent something like 40% stocks and 60% bonds. And I could get up, and so I would actually reduce my risk by adding, and this is really probably closer to 25% stocks if you really want to get technical, but I can reduce my risk and I can increase my expected return by adding bonds, which we just talked about are long-term are negatively correlated to stocks. And that's how you manage this volatility. You're trying to bring this down. And then you could also say, well, you know what, I'm okay with a standard deviation of 8 or 10. I'm going to be up here, and this might represent a 60% stock portfolio and a 40% bond portfolio. And then as you get over here, this might be a 75, 25, and as you get out there to 100, you get this flattening, so you get what we call diminishing marginal returns. And I have this conversation every week with somebody in my office, and that is, I want to be more aggressive because I want to make more money. And the thing is that when you're dealing with stocks and commodities and things that are volatile, what you have to understand is you can have more and more concentration, but your expected return is only going up marginally. Does that make sense? Head nods? Are questions on that at this point? Okay. So that's the basis of traditional asset allocation, is you build out models that create where do you want to be on this risk-return spectrum and how much risk can you take. So I'm going to flip this over, or try, and I'm going to kind of give you the basis for this asset allocation scenario. Okay, got to move it out of here. So when you really try to maximize that curve, which we also call the efficient frontier, then you end up with something that looks like what everybody has always seen when you come in our office, the pie chart. And we know statistically, well, this piece is correlated to this in some way, and this one's correlated to that, and this one's correlated to that, and you end up with so much in large cap this, and small cap, and international, and bonds, and alternatives, and cash, right? And we know that if we use the right combination, there's enough statistical data to push us to the point of that curve on the back of this to get you the maximum amount of return per unit of risk. And that's a statistical process. That whole process works great if you have one assumption that is held true for 30 years that I don't think is going to hold true in the future.
The S&P 500 index is a widely recognized measure of the U.S. stock market performance. It is an unmanaged index of 500 common stocks chosen for market size, liquidity, and industry group representation, among other factors. The Barclays Capital U.S. Aggregate Bond Index is an unmanaged index that covers the U.S. dollar-denominated investment-grade fixed-rate taxable bond market of the SEC-registered securities. The index includes bonds from the Treasury, government-related, corporate, mortgage-backed securities, asset-backed securities, and collateralized mortgage-backed securities sectors. Barclays Capital U.S. Intermediate Government and Credit Bond Index is an unmanaged index that includes U.S. Treasuries, government-related issues, and investment-grade U.S. corporate securities with remaining maturities of 1 to 10 years. Barclays Capital U.S. Long Government Credit Bond Index is the long component of the Barclays U.S. Government and Credit Bond Index and is a widely recognized index which features a blend of U.S. Treasury, government-sponsored, U.S. agency, and supranational mortgage and corporate securities limited to a maturity of more than 10 years. The Barclays Capital U.S. Corporate High Yield Bond Index is an unmanaged index that covers U.S. dollar-denominated, non-investment grade fixed-rate taxable corporate bond market securities. Citigroup 1-month Treasury Bill Index measures monthly return equivalents of yield averages that are not marked to market. This index consists of the last 1-month issues. Returns for this index are calculated on a monthly basis only. The Consumer Price Index is an inflationary indicator that measures the change in the cost of a fixed basket of goods and services, including housing, food, electricity, and transportation. The Sharpe ratio is a measure of historical adjusted performance calculated by dividing the fund's excess returns by the standard deviation of those returns. The higher the ratio, the better the fund's return per unit of risk. Investors cannot invest directly into indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and/or fees and expenses associated with investing.